One of the main points that I want to get at is that A, the Fed is hugely important, and B, no one knows about it, and C, the bad guys like it that way. Because that's really the point. Monetary policy, and I'll argue this a little more in a moment, this is really bread and butter in terms of how many people have jobs. So a lot of us work on things about getting people jobs all the time. That's, we all understand, AFL-CIO, we understand jobs. Jobs are important. The Fed can help people get jobs. They've done that with many of their policies, quantitative easing, other policies they've pursued the last few years. They can also keep people from getting jobs. And that's what raising interest rates is about. And that's one of the bizarre things. I say this to people and they think like I'm a conspiracy theorist. This is the mainstream of economics. So if I had Martin Feldstein sitting here, who you all know and love, conservative Reaganite economist, he would agree. I mean, he used different words. But, if I said, why is the Fed raising interest rates? And I'd say to slow the economy, keep people from getting jobs, meaning there's less pressure in the labor market, pressure meaning bargaining power for workers. Martin Feldstein would agree. He'll use different words, but he would agree. That's not something we argue over. So this is a huge, huge issue. But it's rarely talked about, and, among progressives, everyone's got very important fights, so I'm not going to denigrate, all the things all the people work on. I work on other issues too. But this is really a huge issue, and it's largely ignored by much of the progressive community. And I would say largely because people don't understand it, and I'd say that's, to a large extent, the way they want it. Okay, again, I won't go in great details about the Fed's structure. It's an incredibly Byzantine structure. It was set up a little over 100 years ago, set up in a way no one in their right mind, if you're trying to set up a democratic institution, would have done it. On the one hand, you have the seven governors that sit here, Janet Yellen at the head of it, and happy she's there, very happy. Many of us worked to get her there rather than Larry Summers. That was a victory. So you have 7 governors, I believe there's only 5 sitting there right now, appointed by the president. Principals sit for 14 years, they're approved by Congress. Rarely they actually fill out those terms, but the point is they overlap administrations, they have a lot of independence. Then you have the 12 regional banks. These are essentially appointed by the bankers. I've said that and had people jump on me. It's a little more complex, but essentially they're controlled by the banks in the districts. And again, I won't go into detail, we can discuss that, but essentially they're controlled by banks in the district. The point here is you have a system that's very much weighted towards finance. They're hearing from the banks all the time. We talk about, if you look at an agency like the FCC, okay, they hear from NBC, they hear from, the other large media, communications industries, but they lobby them. In this case, they're actually sitting there. Okay, it's like the FCC was sitting there, and you had Comcast had their person, CBS had their person. They're just sitting there, and that's really how you should think of as the Fed. So it's this enormously important institution, and it's hugely dominated by finance, and that's why it's really important that we try to push back the other way. So let me go through the basic argument. The main point is. The main points I want to make, unemployment's the main determinant of labor market strength and wage growth, and that currently the economy is still quite weak. The labor market's quite weak. We've had a lot of celebrations of it. I want to point out why those celebrations. I mean, it's good. We get 267 or 257,000 jobs last month. That was good, but we have a really, really long way to go yet. The first point, I'll go into this a little bit, but I wrote a book with Jared Bernstein a year and a half ago about returning to full employment, bear bargain for working people. And the main argument there, we had many arguments, but the main argument there was that if we want to see wage growth, we need lower unemployment, at least for those at the middle and bottom, the wage distribution. And what we were really struck by, and we've done more analysis than this, but we're really struck by, if you look back from the early 80s till the present, the only period where you had strong wage growth for workers at the middle and bottom was the late 90s, and that was when you got low rates of unemployment. And our argument is that wasn't an accident. So if we want to see wage growth for most workers, we need much lower rates of unemployment. Okay, this is just basically showing this point. This is response to a 10% decline in the unemployment rate. Let me be clear what that means. 10% means of its own rate. So if we had a 6% unemployment rate, a 10% decline goes to 5.4. It's 0.6 of a percentage point. And this has a very, very large wage effect. If you look at the 20th percentile, that implies an increase in wages of about 12 percentage points for men and about 8 percentage points for women. The point here is, this is if you sustain the lower rate of unemployment. So if, my dream world, well, maybe we could do better, but let's say my dream world, we had the 4% unemployment we had in 2000, and we sustained that. Okay, so that would be much higher wages for workers at the middle and bottom. And as you see, you get to the 90th percentile, the effect's very small. It's a small negative. Those are essentially insignificant. Okay, so basically, and a way you might think about this to make sense of it is, when you have high unemployment, who loses their jobs? Retail clerks lose their jobs, factory workers lose their jobs. For the most part, it's not the CEOs, it's not doctors, it's not lawyers. So when we're talking about adding more workers, it's workers who are at the middle and bottom of the wage distribution who see an increase in their demand, relatively small impact for those at the top. Okay, so why am I saying the labor market's still weak? The argument that the people want to raise interest rates are saying is, well, labor market's getting very tight. The unemployment rate is 5.6%. Some people think that's as low as it can go. Historically, that's not a terribly high unemployment rate. So, the question is, why shouldn't the Fed be tightening up? So that's the argument. Well, labor force participation, this is prime age workers. This is one of the pieces of data economists look at a lot. And a big story in this downturn, I was going to say a big story to anyone in this downturn, there's been a lot of workers dropped out of the labor force. Now, you've heard people say, I'm sure you've heard people say, well, this is demographics, baby boomers are retiring. We know the baby boomers are retiring. But this is 25 to 54-year-olds. Those aren't baby boomers. Well, the oldest are baby boomers, but they're not retiring in any case. Okay? People aren't retiring at age 51, 52. Okay? So why did people suddenly decide they didn't feel like working? If you're not in the labor force, that means you're not working, and you say you're not looking for work. Well, I think there's only one explanation, that they don't think there's any jobs out there. Okay, that's a reasonable thing. You've been looking for a job for 6 months, a year, 2 years. Well, after a while, you stop looking. I think that's the only plausible explanation. I've had economists say, well, this is a long-term trend. That's nonsense. People didn't just decide they don't feel like working. They decided they gave up looking for work because they don't see jobs out there. Point here is that if there were jobs, a lot of those people, I don't know if all of them, a lot of them would come back in the labor force and be looking for work. Okay, again, after a while you give up because, it's kind of a waste of your time and money going around, place to place looking for jobs that aren't there. Okay, second point, just emphasizing that, the weakness of the labor market, involuntary part-time. I really kind of like this because I don't like people being involuntarily part-time, working part-time, but the point is there's not much confusion about this. People are not choosing to involuntarily work part-time. And just to be clear on the nature of, what this question is answering, we have our survey every month, the employment survey. They ask people if they're working less than 35 hours a week. Next question, why are you working less than 35 hours a week? A lot of people choose to, and that's fine. In fact, I've written about this. The Affordable Care Act allowed a lot of people to work part-time who, didn't want to work full-time. They have kids, they have other reasons they don't want to work full-time. That's great. These people say they want to work full-time, but they're not able to. Why did that suddenly spike? Why is that still way above the pre-recession level? Give me an explanation that doesn't have the words weak labor market in it. Okay, there isn't one. There isn't one. So we see we still have about 2 million more people involuntarily working part-time than before the recession. Again, to my view, this is a very clear indication of a weak labor market. Third point, taking one from Alan Greenspan, he always said this was very important to him. This is the percentage of people who report being unemployed because they voluntarily quit their last job. Okay, the idea here is, people are unemployed for different reasons. A lot of people are unemployed because they were laid off. A lot of people are unemployed because they just started looking for work. They were just graduated school, or they were out of the labor force for a period of time, raising a kid, whatever. These are the people who say, well, they're unemployed because they didn't like their last job. They quit and they're looking for a new job. Well, story here is you're not going to do that if you think there's very little chance of getting a new job, if the labor market's very weak, or your perception is the labor market's very weak. Well, quit rate's up. I mean, if you compare it to where we were back in 2009, 2010, it is up from that, but it's still very low. So if you look compared to where we were at 2005, 2006, 2007, which was not a great labor market by any means. We were all complaining about it then. So it wasn't by any means a great labor market. We're still way below that level. And if you compare where we were, when the labor market really was strong, 99, 2000, the quit rates there, they peaked at over 15%. So we're looking at a quit rate that just got over 9%. It was at about 12% if we go back to 05, 06, before the recession. And if we want to take a really strong labor market, we'd be looking at 14, 15%. So we have a really long way to go. And again, this is workers' own perceptions of the state of the labor market. I kind of like this because it's not, people like me telling workers what they should think. This is workers telling us what they think. And they think that their job prospects aren't very good, and that's why they're not prepared to quit unless they have another job lined up. This is the Fed's own criteria. The Fed ostensibly is targeting 2% inflation. And I should point out, this is not a law. The law that the Fed is governed under requires them to target price stability and high employment. Those are very ambiguous terms that have been interpreted in all sorts of different ways. Recently, Ben Bernanke, when he was Fed chair, said we're going to target 2% inflation. That has no legal standing, by the way. Okay, this is Ben Bernanke thinking that's a good idea. And future chairs, Jan Yellen, whoever may follow her, may feel bound by that, may not. Ben Bernanke didn't feel bound by Alan Greenspan, who said he didn't think a 2% target was appropriate. He said he wanted more flexibility. So that's not binding. That's, it carries weight. A Fed chair said that. The rest of the Fed went along with it. But that can be changed. But let's just take that. Okay, so their target is 2%, the personal consumption expenditure. That's the measure they explicitly said, and core personal consumption expenditure. That means you exclude energy, exclude oil. And by the way, that doesn't mean we don't care about overall inflation. We do. This is just what they're using for targeting, when they think inflation is too high or too low. Well, where is that? It's well below 2%, and it's going down. Okay, so why would you raise interest rates because you're worried about inflation when inflation is below your target? And keep in mind that's an average. It's not a ceiling. That's an average. So it's below your target. It's been below your target for the last 4 years, and the immediate course is down. Okay. Why on earth would you be raising interest rates in that context? What are we hoping to accomplish? Why would you be slowing the economy? Okay, so that's, to my view, a very perverse story. So again, just to step back for a second, I understand that the Fed would move if they think inflation is really getting out of control. And what that means is, up in the air somewhere. When is it out of control? We don't have any stories, the stories that inflation just, shoots up and suddenly we're looking at, 10, 20, we've never seen, if we had a war, if we had some, natural catastrophe, yeah. But the economy in normal times just doesn't work that way. But, let's say it started to go up to 2.5%, 3%. Fair enough, that's nothing to worry about. We're talking about an inflation rate that's under 1.5% and hitting down. Okay. Very hard to see an argument in that context for raising rates, slowing the economy, throwing people out of work. Okay, so just to sum up, the inflation story just doesn't really make a lot of sense. Let me digress a little bit on this because I'm going to recount and give up some confidences that I think say a lot about the Fed. They're 20 years old, so I don't think I'm still bound by them. I had a meeting, this was back when I was at the Economic Policy Institute, I had a meeting with Ellen Blinder and Janet Yellen in early 1994. They were both governors of the Fed. And I'm saying this because they both, in the scheme of things, quite liberal people, liberal economists, and among the best people you'll ever have at the Fed. And we were concerned at that time because the unemployment rate was about 6.2%, it was headed down. Similar story to what we're looking at today, it was a little higher. And we knew, we knew the research, we knew what people were saying, we knew they were going to start raising the interest rates because there was a whole body of research saying that, if the unemployment rate gets under 6%, inflation will start to accelerate. They didn't want the unemployment rate to get under 6%. So we were there to argue that, look, you really don't have to worry. That research is very weak. I had some research I'd done, some work by other economists, arguing, look, you can let the unemployment rate get under 6%, no big deal. And Alan Blinder was the main person I was arguing with, and he was saying, well, I really don't buy that, buy this. And, I know the basic models. The extent to which a low rate of unemployment, let's say he was right, in other words, you can't get below 6%. The extent to which going below that, 5.5%, 5%, leads to a rise in inflation is very gradual, very slow. I know the research, he didn't dispute that, it's very slow. So give the sort of quick number. If the true rate were 6%, we shouldn't get below 6%. If we're at 5%, after a full year, the rate of inflation will be 0.5 percentage point higher. So I asked Blinder, I go, well, okay, let's say you're right. What would be the consequence of that? He goes, so you're asking me what would be the cost? Because I said you could always then raise the rate back to 6%. Tied up. He goes, you're asking me what the cost of low rates of inflation are? He's written on this, very low. He goes, well, I have to say very low. Okay. So I go, okay, so what's wrong with trying that? And he goes, well, the Fed's an institution that's committed to price stability. So I said, well, you're also an institution that's committed to 4% unemployment. At that time they were, changing the law. But, and then he goes, oh, no one takes that seriously. And I said, well, you don't have to take the commitment to price stability seriously. And he goes, yes, I do. And I thought that just spoke volumes. And again, I'm not trashing Blinder. He was giving me the reality. They have to answer to the financial community. The financial community is very upset about inflation rising. So they'll be very unhappy if the inflation rate rises to 2.5%, 3%. For the rest of us, if wages keep pace, what the hell do we care? I've lived through, 9%, 10%, 11% inflation. Most of the 80s, inflation was 3 to 4%. No one thought it was a big problem. But the financial industry, the reason why they care, they've made loans. They have long-term loans. They've made loans at 4% interest. If the inflation rates start rising, they're taking a big hit on those loans. They really care. They care about higher rates of inflation. And frankly, they don't really care about unemployment. I'm not saying they're bad people, but it's not something they go to sleep worrying about every night. It's not them who's unemployed. Odds are no one in their family's unemployed. So the Fed reflects the concerns of the financial industry, which is inflation is really, really bad. Unemployment, again, I'm not saying they like it, but, it's not the main concern. Second point, again, labor market. I gave you 3, I thought, very good indicators. I could give you a lot more, but I think 3 very good indicators that the unemployment remains very weak. Labor market remains very weak. Third point, if the labor market doesn't tighten, we aren't going to see wage growth. I've seen, I don't know how many articles in the media recently, why aren't wages rising? Go, idiot, wages aren't rising because the unemployment rate's not lower. It's really not a big surprise. We get the unemployment rate down, tighten up the labor market, wages will rise. I'll promise that. And I'll give up my economist card if that doesn't happen. We get 4.5% unemployment, we'll see rising wages. I'll bet that. Higher interest rates, again, it's just amazing, not to say that all these things aren't important. The Keystone Pipeline, we're talking about 35,000 jobs. No, that's not trivial. People get a job, that's a big deal for them. But, if the Fed raises the interest rates, we're talking about keeping millions of people from getting jobs. So if you freeze the unemployment rate 5.5%, when let's say you could get to 4, I don't know, but let's just say you can get to 4, that's about 4.5 million people. Okay? 4.5 million people not having jobs otherwise would have them. That is a huge deal. That's more than 100 XL pipelines. Okay, last point is just, I'm not a deficit hawk, as those of you who know me know. But if you care about deficits, if you want to get the deficit down, there is no better way than get the unemployment rate down. And the story, the Clintonites will hate this, but it happens to be true. The story of the budget surpluses of the 90s were not Clinton's tax increases and spending cuts. That got us part of the way there. But if you look at the projections that were made in 96, when all those were already in law, they still projected substantial budget deficits for 2000. The reason why we instead got budget surpluses was because the economy grew much more, and we had a much lower rate of unemployment than was projected. CBO projected the unemployment rate would be 6% in 2000. It was actually 4%. You want to get a budget deficit down? You want to see you're concerned about that? Get the unemployment rate down. That is the most effective way. That dwarfs anything else that someone can conceivably put on the table. So long and short, we should be very concerned about the Fed. There's a great campaign, the Fed Up campaign led by the Center for Popular Democracy right now. I've worked on the Economic Policy Institute still, and I've worked on it. A lot of the other organizations here, I'm sure, have worked on that. We can influence them. And, I was saying earlier, that, one of the great things about its undemocratic setup is they're unprepared to deal with, popular response. So I think there's a great opportunity to try and influence the Fed here, and it's enormously important. So I'll stop with that.